Hey there, welcome to another episode of Be the Boss of Your Money. I'm Mitch Goldberg. This is the post show, the post market show. We talk about personal finance, the day's events. Basically, we get into the stock market, what happened, why. Like I said, it's a post market show, but there's a lot more to it. There's personal finance, a lot of math involved. Don't worry, I don't get into the math too heavily here. Not that you can't handle it, okay? Just to put my thumbnail up here real quick. The rebound. Investors who hung on are rewarded. I had a really good day today. It has nothing to do, by the way, with the stock market. I just had a really good day. I saw some really good people, and a lot to be grateful for. So we're going to talk about the market, the rebound. What should you have learned from this? What should you do now? What did you do before? Did you panic and sell? Did you raise cash before and buy after and buy? Or did you sell it at really lousy time and now you're scrambling to figure out what you should do with the cash now? This is all about really personal finance and psychology. So let's roll the quick intro. We've got a good show. We're going to make you a better investor, better with your money. That's why this show is called Be the Boss of Your Money. Here we go. Hey, everyone out there. Thank you so much for joining me. Hey, Josh, how are you? Facebook feed is not working. You know what? I got a notification a little while ago from StreamYard. StreamYard is a service that I use to live stream to the various social media platforms. And there have been some issues with Facebook today that StreamYard made us aware of. They're trying to correct it. That does happen. These are the vagaries of going live, by the way, folks. Look, I'm doing this live right now. It's 4:35 Eastern time. You might see me with a 5 or 10 second delay, but I do this live. There's no rewind. There's no editing. Hopefully that Facebook feed is working now. If not, then I'm glad you told me, Josh, because if it doesn't, then I'll repost it on Facebook later. But let's talk about the market. Market had a phenomenal day, but there's a couple of things that we I think need to get used to. All right. So for starters, you know, 500 points ain't what it used to be. All right. So I'm going to put on the screen. We'll go through the numbers real quick. Thank God it's Thursday. That's every Thursday is the Thank God It's Thursday edition. We get Friday tomorrow. Looks kind of gloomy outside. It's gloomy as hell outside right now. I'm in New York. I'm in Long Island, staring outside my office. You know, I'm in a typical suburban glass office building, 4 stories in Melville, Long Island, off of Route 110. And it is gloomy as hell and windy like you can't believe outside. The weather's getting really bad, and I'm gonna go put myself up in the screen if I can. Okay, screen 3, camera. Hi, camera 2. Hello, camera 1. And for some reason, I'm not getting camera 4, so screw it. All right. I hate when I have these technical difficulties. That's the whole day. If you're watching this, and I know you're watching this, hey, if you have a question, ask me in the comments below. Why'd the market go up? What should you do now? What's next? Let's talk about personal finance. Let's talk about investing. The Dow was up a little over 500 points. It was up 1.48%. Look, 1% days definitely get my attention, but I don't get computer face, and I don't want you to get that either. That, computer face means when you look at the stocks all day, your Quotron. That's what we used to call our computers back in the day. And you just look at it like this all day. And then you look at the news. You look at news on a stock and a company that just came out. Read what the Fed said. Read someone else's opinion. Read something on another website, and you get this computer face. And it doesn't really do you any good. But you feel like at least you're working. You're doing something. And I think personally, one of the toughest things to do is knowing what to do next. And I think that goes for anyone who has clients anyone who's in, business development, you've got to know what to do next, and it's not always apparent. Okay, so let's see if this can come in now. All right, here we're in business. All right, here we pop myself up here. All right, so you see this. Hopefully, you can see that on your smartphone. Yeah, you can see that. Up 500 points, up 1.48%. NASDAQ was up 1%. S&P up 1.21%. These are good numbers. Now, let's take a look at gold. I could talk about gold. I could do a whole show just on gold. A friend of mine was on the show yesterday who's watching with us yesterday, commenting on a very good friend of mine. And he's into precious metals now. He thinks they're undervalued. This is just one person's opinion. He's not a financial advisor, but he is an investor. And that's the beauty of the market. All investors are entitled to their own opinion. Okay. I don't really see anything redeeming about gold. It's shiny. Gold objects could be pretty, but as an investment, this just never seems to work. It kind of hits around 1800, 1850 the ounce and goes back under 1800. The fact that it's down today, down over 2%, just goes to show you that there's really not a lot of utility for gold, not a great inflation hedge. I'm not saying it's not a good store of value. It's not volatile like crypto. So you could put some money into it as a store of value if that's what you want to do. Let's say you've got a certain amount of money, you want to put 5 or 10% into something besides dollar-denominated assets, you could buy gold. But as far as an inflation hedge, gold keeps telling us that, and it's been like this for the last 2 years since I've been doing this live stream. It consistently tells you inflation is not a problem. And that's what Jerome Powell, the chairman of the Fed, keeps saying. Jerome Powell, okay? So let's go to camera 2. Let me get nice and relaxed. Jerome Powell, chairman of the Fed, he keeps telling us that he sees inflation as temporary, as transitory. Now, he's saying in his meeting yesterday, the Federal Reserve met yesterday. They meet every 6 weeks. So their September meeting was yesterday. There is no October meeting. Their next meeting is November 3rd. What he said is, yes, inflation is up, and it's not going to be as short-term as we thought. But there's reasons for that. And those reasons are predominantly supply chain related issues. There's issues with Chinese ports, American ports, getting goods back and forth. COVID has interrupted a lot of trans-Pacific shipping. For example, in China, if they get like one COVID case at a port in China, they close the whole port down. Can you imagine that happening to the ports, for example, in Long Beach, California? So there's also a shortage of semiconductor chips, clearly hitting anything tech-related, crushing the car industry. But raising rates is not going to help the shortage of products, of the supply chain issues. So yesterday was a huge deal. Jerome Powell was firm, chairman of the Federal Reserve, saying we're going to taper. We should be finished with our taper. I talked about this yesterday. I want to just reiterate today. We're going to be done with our taper probably mid-2022. Okay, so less than a year. So somehow the Fed between now and the next 9 months or so is going to be tapering their bond purchases. It doesn't mean they're going to be selling bonds. It doesn't mean they're going to make money harder to get. It just means that they're going to be providing less and less stimulus for the next couple of months until they're not providing any quantitative easing stimulus. But they'll still keep interest rates at or near zero. And the hurdles to raise interest rates in the Federal Reserve's eyes are a lot higher than getting rid of the current bond buying program that it started early, in January this year. They don't need it anymore. The economy is functioning. Now, can the economy function on its own at this point? Yeah, I think so. That doesn't mean the stock market can't go down. I don't think the Fed should be making its decision on what it does solely based on the stock market. But the fact is, and I had this conversation a million times. I had it today with some dear people who I had lunch with today. The kind of people who are start out as clients, they became friends, they become family, and then become people you could take, silly pictures with, hug it out, hug and kiss, and it's wonderful to see. That's like the best. By the way, that is the absolute best. I love that. Anyway, yeah. So whatever happens in the economy, we have to look at only a handful of stocks: Facebook, Google, Amazon, Apple, Nvidia, Netflix, Microsoft, Visa. These are really the only stocks that count, in my opinion. They're the biggest ones. They take up most of the size of the market cap in the S&P 500. And as long as they hold up, you're going to see the S&P 500 hold up. You're not going to see all the damage of all the stocks that are down so much in the S&P 500 because they're small. A company with a $20 billion market cap or $30 billion market cap in the S&P 500 could disappear tomorrow. You won't even notice it in the S&P 500. But if Apple goes down $1, yeah, that you'll actually see that in the S&P 500 because Apple's a bigger company, so it has a bigger impact on the index. So I just want you to know that I keep saying Bernanke, but it's Jerome Powell, chairman of the Federal Reserve. He's going to taper. And after the taper comes the interest rate hikes. Now, the interest rate hikes is another interesting story that we're not facing yet. And if we have a decent economy, a few interest rate hikes are easily absorbed into the market. And I'm thinking that this isn't like the 80s or 90s, where whenever the Fed raises rates, stocks have to go down. You have to look at how rising rates impact those top 6 or 7 or 8 companies that I just mentioned. And I think the trajectory for these companies is so unbelievably strong that what the heck does interest rates have to do with it? I mean, if you take a look at Amazon, they don't borrow money. Apple has some debt, but who cares? They could pay that off in 1 second. We've got hundreds of billions of dollars on the balance sheet. So I don't think rising rates are necessarily a death knell for the market. Now, a lot of you are going to say, how unconventional, Mitch. Don't you know that rising rates kills the market? Your rising rates hurts high-flying stocks, meaning high PE multiple stocks and stocks that are trading at very high sales to price ratios. True. And I'm not saying those won't get killed. I think we saw a lot of that, though. Look what happened to the SPACs. Look what happened to some of the cryptos. High-flying assets have already taken it on the chin. A lot of industrials have gone down. So the last couple of days that we saw, especially like the last couple of weeks, which crescendoed this past Monday when the Dow was down 614 points, which I didn't even think that was that big of a deal. I know a lot of people think, 600 points down on the Dow is such a big deal. It's, it's like 1.6, 1.7%. We get those once in a while. Just, you have to remember, the Dow is almost 35,000. Okay, so 500 points just ain't what it used to be. All right, so what else do we have to go over? Let's take a look at a couple of other things. All right. 10-year Treasury yield, 1.43%. It's getting up there a little bit, the 10-year Treasury. That's this one over here, okay? 1.43%. And I'm not overly worried about it. It's actually good for the bank stocks, and that's an area that I'm pretty heavily financials are an important sector of the market. Okay. The Russell 2000 was up almost 2%. That's a big move. The Russell 2000 had been leading to the downside. Now it's leading to the upside. By the way, the Russell 2000 is named after a guy named Russell. And I'm only kidding. I don't know. I'm sure it is named after someone whose last name is Russell. But however, the Russell 2000 is a small cap index. It's the predominantly followed small cap index. Smaller companies, 2K means there's 2,000 stocks in the index. Small cap companies are typically more sensitive to the U.S. economy, to the ups and downs of the economy, because they're more likely to get their revenues domestically. And they don't have quite as easy of a time borrowing money as much bigger companies do. Okay, so let's go to the watch list. Let me just change a couple of things here. You could follow along over here. Okay, let me pop myself up on the screen. Okay, GE up almost 4.5%. Southwest up 3.3%. I'm thinking this is good because a lot of my stocks led the way, but I want to look at sector ETFs. Okay, XLE, energy, financials, industrials, materials. What do I always tell you? These are the 11 sector ETFs, which represent the 11 sectors of the economy. When you have energy, financials, industrials, and materials leading the way, that's a super strong vote of confidence for the economy, for the future, for the market. Now, this changes. We've seen this change so often to where healthcare leads the way, tech leads the way, consumer staples lead the way. But overall, this was a really solid day. So let's talk about what you did the last couple of days. When the market hit the skids the last week and a half, 2 weeks, that's really the last 3 weeks. And then this week it was down 600. What did you do? How did you react? Did you sell stocks into the downtick on Monday? Did you panic? Did you lose sleep? Were you thinking, it took years to accumulate these assets, I'm going to give all that money back so fast? You know, the most recent gains in the market are always the most recent gains that are lost in a downtick. And, you know, it's painful to see that go away, right? For a lot of people. Or did you buy the dip and put money to work? Or did you just say, I'm invested appropriately based on my life cycle, my needs, my goals, my risk tolerance, and you didn't really have to do anything? Hopefully you were the latter, okay? I always ask, what good is an investment what good is an investment portfolio if you can't stick with it? So if you're making hasty decisions and we're selling into the downtick and then you're buying everything back, you're doing it all wrong. Okay. Remember what we spoke about on Monday and Tuesday? Disney was down like $7 a share one day. And I said to you, if you were looking for a particular stock like a Disney to buy, and you would love to buy that great company, but the stock keeps going up and you feel you missed it, but you want to get it next time it goes down. When it goes down, it's not going down, whatever stock it is. They're not going to go down because things are good. Usually a company will come out with some negative news, catch a few people off guard. It'll be a surprise. The stock will go down. And then that is your opportunity. If you're worried that it could go even lower, you don't have to take a full position. Maybe you'll buy a little bit at a time. If it goes lower, buy a little bit more, scale into it. I use limit orders for that for my clients, percentage gains, percentage limit orders, below the market limit orders, things like that. So that's what you have to do. It's not like a stock is great, the stock is up a lot, but because you're so special, you're going to get the stock for a bargain. Just because, why not? Just because you're so great. No, it doesn't work that way. When you see that great stock that you've been looking to buy that keeps going up when it finally goes down, it's not finally going down because things are good. Something happened. There was bad news. That's your opportunity to pounce. Personally, I find that it doesn't even pay to wait to buy a stock that you like. In my own experience of almost 32 years of doing this, that if there's a stock you like, I find for me, if there's a stock that I like, waiting for it to go down has almost always been a mistake, because the stock goes up and up and up. And when it finally does go down, it's still a lot higher than when I could have originally purchased the stock. So waiting for better times in a stock market that has generally gone up for the last 100+ years has really not been a winning strategy. Everybody thinks the next time the market crashes, I'm going to get in there and do all that buying and make all that quick cash. Generally speaking, when the market crashes, it's because the economy or something really bad happened, like the pandemic or the housing crisis in '08, or because of the tech wreck in 2000. And that's typically when you're already invested, right? People are already invested. They don't want to put more money into the market because they're afraid, they're scared, they don't know what's going to go on. Because every time there's a new calamity, it always seems worse than the one before. It's always this is it calamity. So waiting for crashes to buy, you still would have been better off not waiting for crashes. Even if you bought at the peak of the market right before the pandemic, let's say you went into the S&P 500. By the way, the S&P 500 is an index. You can't actually purchase an index. You can't put money into an index, but you could purchase a security that tracks or mimics an index. But let's say you put all your money into an S&P 500 index fund at the highest point right before the pandemic. You might be kicking yourself 3 months later, but today you'd be doing pretty well. But if you waited for the all clear signal, the market would already be up. The point is this: I've seen more opportunity lost to hesitating than anything else. Hesitation is even worse than bad timing. And I can prove that out. Hesitation is worse than bad timing. All right. So that's what I have for you today. It's a pretty quick show. The stocks that we needed to rally have rallied. I think we are back. The downtick in the S&P from its recent peak to its very recent low last Monday, it was less than 5%. Within the realm of normal. It might not be normal for the last 12 months, but we see these kinds of downticks all the time. They're not something to get scared about. If you didn't, if you had a portfolio based on your personal metrics, your life cycle, your time horizon, your goals, then what we saw on Monday was just volatility. Do you know what the difference is between the last thing? Do you know what the difference is between volatility and risk? Volatility is the ups and downs of the stock market when your goals are far into the future. Risk is the ups and downs of the stock market when your goals are in the near future. Make sure you understand that, and you, I believe, will be the boss of your money. Much better investor. All right. I'm going to get going. I'll be back Monday. I don't do the show on Fridays. I want you all to have a great weekend. You have any questions, you want to talk to me about investing direct, DM me, call me, send me an email, smoke signals. I reply to all of them. Well, not the smoke signals, but I'm trying to be clever here. And I look forward to seeing you guys soon. Thank you very much. Bye.